You see it all day on the financial news networks. The ticker flashes green or red, declaring that gold is trading at exactly $2,300 an ounce, or that silver is sitting at 28. But if you try to actually transact at those numbers, you quickly realize you can't. Try to buy a physical sovereign coin like this American gold eagle, and you will pay significantly more than that quoted spot price. Or try to sell. You walk into a local storefront with an old gold chain, and the cash offer they slide across the counter represents a steep discount from what you saw on the screen. The gap extends even to the stock market. Junior mining companies sitting on millions of proven ounces of unmined gold routinely trade at pennies on the dollar relative to the metal they own. The quoted ticker price represents a perfect frictionless market. For everyday buyers and sellers, that number is an institutional illusion. To understand why the math never seems to line up, you have to understand what the spot price actually measures. It is the product of highly leveraged futures markets and over-the-counter clearing networks traded directly between massive institutional banks. These trades occur at staggering volumes. They require the exchange of massive 400-ounce good delivery bars, settled immediately within highly secure, closed vault systems. At this level, there is zero retail friction, no paying for beautiful designs, no residential shipping costs, and no consumer default risk. Unless you are a bullion bank trading multi-million-dollar contracts, you exist outside that vault. Every single step it takes to move metal from that institutional clearinghouse into your hands introduces logistical friction, and you have to pay for it. Think about the physical manufacturing costs required to transform raw institutional metal into recognizable retail products. The metal has to be re-refined to standard purities, minted, packaged, insured, and shipped. Those logistics create the retail premium. This is the mandatory markup you pay over the spot price to cover fabrication, secure transport, and the local dealer's operating overhead. This creates the dealer spread. The taller bar is the ask, the lower bar is the bid, and the gap is the spread. You start your investment in the red. The spot price must appreciate just for your resale value to match your purchase price. When you buy physical bullion, you are trading upfront financial efficiency for absolute, tangible security. The friction works against sellers, too. If you are liquidating jewelry, you face the immediate complication of alloys. A gold ring is rarely pure gold. It is mixed with copper, zinc, or silver for durability. To determine actual melt value, multiply spot price by caratage divided by 24 and weight. A 14-carat band is 58.5% pure gold. But at a local pawn shop, the cash offer will typically be only 40 to 45% of that value. That steep discount is the price of their logistical burden. The shop must cover local rent and absorb the risk of holding a volatile asset, and ultimately pay their own fees when they ship the aggregated scrap to an industrial refiner. You could bypass the storefront and send your scrap directly to high-volume online refiners. They pay out 90 to 98% of the melt value, but they require minimum lot sizes, charge assay fees, and make you wait weeks for processing. Demanding immediate cash liquidity at a local storefront forces you to forfeit over half of your asset's intrinsic value. Equity investors face a similar disconnect. You will often see junior mining companies sitting on millions of ounces of gold in the ground, yet their stock trades at mere pennies on the dollar compared to the spot price. This visualization highlights the in-ground discount. Contained metal buried in dirt is valued at only 10 to 30% of the spot price, because getting it out of the ground is remarkably difficult. Massive capital expenditures are required before a single ounce is poured. Heavy machinery, infrastructure, and complex extraction all eat directly into the profit margin. Even after the rock is crushed, metallurgical recovery losses and the future cost of environmental remediation further reduce the final refined yield. An investment in a mining equity operates as a bet on business execution and geological probability, rather than a direct claim on the gold itself. For investors seeking convenience, closed-end physical trusts offer a way to trade precious metals on public stock exchanges without the burden of vaulting physical bars. But as this line graph shows, there is a catch. The trust unit price frequently trades at a discount to the net asset value, meaning the shares are priced lower than the actual value of the metals sitting in their vaults. In a standard ETF, traders use arbitrage to close that gap. But in closed-end trusts, retail investors cannot redeem discounted shares for physical metal. The trusts allow redemption only at extreme thresholds, often a minimum holding of roughly $1.8 million for a single bar. Without institutional capital to force the arbitrage, you trade true physical ownership for ultimate convenience, leaving your investment trapped in market sentiment discounts. Knowing these logistical costs gives you a defense mechanism. If you want to protect your payouts, you have to use math to fight friction. Step 1. Sort your scrap by carat purity. Step 2. Weigh it accurately. And be precise with your measurements. As this graphic details, jewelers use troy ounces, which weigh 31.1 grams. If you use a standard kitchen scale, which uses 28.3 grams, your baseline valuation will be instantly wrong. Step 3. Calculate your raw melt value beforehand using the current spot price. Step 4. Solicit quotes from direct-to-refiner platforms to establish a baseline before you ever speak to a local buyer. Walking into a negotiation without calculating that baseline guarantees that you will absorb the buyer's maximum profit margin. For buyers, success comes down to selecting the correct vehicle for your specific goal. There is no perfect asset, only the right trade-off. If your goal is wealth preservation, buy physical bullion. You will pay upfront premiums and dealer spreads, but you secure an absolute, counterparty-free asset that you control entirely. If you are a speculator, buy mining equities. You take on severe geological and operational risks, but you gain the potential for outsized, leveraged returns during a bull market. And if you are a convenience investor, buy closed-end trusts. You accept the NAV discount and forfeit true ownership, but you gain supreme liquidity and zero vaulting costs. The quoted spot price is merely the institutional starting line. Success in precious metals requires accepting that purity, scale, and convenience all come with an inescapable price. Deciding which one you are willing to pay is where the real